Hello and welcome to LiveSquawk's Market Talk Review. I'm joined in today's episode by Sam. Let me start that again. See, already done it. In 3, 2, 1. Hello and welcome to LiveSquawk's Market Talk Review. I'm joined today by Sam Cutler, Portfolio Manager at 333 Capital, and LiveSquawk's European Editor Eric Culp. The three of us will go through not only last week's events and data points, but also we'll review and brief on some of the upcoming data, central bank commentary, and the latest geopolitical news. There is a lot to unpack, so we shall crack on. Before we do that, though, just quickly, the content provided on this channel is for the informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, Sam, how are you doing?
Hey, Harry, not too bad. Can't complain.
Yeah, well, let's give that 5 minutes. And then Eric, how are you doing?
Yeah, good. All good here in Frankfurt.
Excellent. So we will crack on. I'll just to give a quick rundown of what happened last week, really. So highlights last week, we saw the FOMC rate decision. They kept rates on hold as expected, but and that didn't really change much of the language. We will hear from Powell again this week, but at the press conference last week, I'd say it was pretty uneventful and not too much to pour over. We heard from, I've got a note here from Barclays. It says the FOMC remained in a holding pattern with Chair Powell downplaying updated dots showing 2 cuts this year. As we and the Fed await greater clarity about how tariffs will affect prices and activity, available May estimates point to subdued growth and soft inflation. Sam, we'll come to you on this one. What did you make of last week's meeting?
Yeah, I mean, I think it was pretty much as expected. The only thing that was like you said there with the dots. I think the market was expecting it to be dropped down to 1 cut. But if you really look at the details, I mean, we were only 1 vote away from the dot being to 1 cut. So it's pretty hard to take that. And I think the market realized that it wasn't really as quite of a, dovish surprise as they thought it would be. But yeah, I still think they're in wait and see mode here. They want to see the impacts of these tariffs. They believe they're going to be inflationary, but it's only going to be a one-off price jump. So I just think they're afraid of getting that call wrong again. So they're really just in wait and see mode. Is there a little bit of political, games at play there? I don't think so. I don't think Powell's like that. I think he's done an excellent job navigating these markets. But I don't see them having the need to act on anything yet, right? We're going to get soft PPI metrics. If you put it together right now, we're looking at probably a 0.1% print in core for this month. I think we get that this Friday.
Yeah.
It's going to be pretty cool. That puts year-over-year pace probably going to be in that 2.4 to 2.6 range. So it's getting muted. And if we do get that one-off jump, I hate to say the word, but it's transitory, right? It's just a one-off price level impact that actually impacts growth. And we've kind of seen that with these inflation prints we're getting, where we have seen kind of the sectors that are exposed more to the China tariffs. They have picked up a little bit, but we're completely offsetting that with the services disinflation we're getting now. So weaker growth, I think, is going to be the dominant story in the second half of this year. Okay. And I think that is going to be where the Fed eventually shifts their focus to. I mean, like we spoke about a couple times before, headline numbers on the jobs front are good, but when you look under the surface, it's not great in all these negative revisions that are coming. So I'll be very curious in, 2 weeks' time, we'll get another NFP print, see that previous print revised. That'll kind of really start to set a trend for us here that I think the Fed will open up their eyes to. And I think that's the story for the second half of this year is the weaker growth and the actual underlying weakness in the labor market that's going to come out. And I mean, I think you see something similar in the UK as well with the UK employment backdrop.
Yeah, well, before we get on to the UK, and we will do that shortly, just to quickly pick up on what you're saying there. So you think there's some case for Fed Governor Waller and his comments. For anyone who didn't know, he was in an interview speaking on CNBC on Friday and said rates could be cut as early as July. He premised this by saying he doesn't expect tariffs to boost inflation significantly, similar to what you said, maybe one-offs. So policymakers should be looking to lower interest rates as early as next month. To quote him, he said, if you're starting to worry about the downside risk to the labour market, move now, don't wait, was his advice. We did hear from Daly later on the day on Friday as well, and she would be more comfortable with waiting until there's more clarity on the impact of tariffs. But again, it leads to your directive there that we are looking at maybe a slowing significant enough in the second half of this year to warrant the tenuous 2-cut dot plot, I guess.
Yeah, for sure. Yeah, I could see that. I think what would make the most sense, honestly, is probably what the market has priced, right? They cut in September, then they cut in December. I do think, though, just like on a probability basis, the delta for the July meeting should be a little higher than it is, right? I think it's right around a 14% chance of a cut. I do think that should be a little higher. So the market's not really pricing in, any chance of a move in July. And what happens when you get another soft inflation reading, and maybe now we get a weaker jobs report in July. I don't know how the jobs are going to look. I'm just saying, what if that's the one that comes through? That delta, I think, should be a little higher than what it is.
Fair enough. Okay, Chris, we'll move on because, again, we can't dwell too long on too many of these things. We'll be here all day. We did see UK inflation last week and the Bank of England report as well. Bank of England event was a non-event outside of the voting. But in a low-key event, the Bank of England left its main lending rate unchanged. As expected, the committee voted then 6-3 in favour of holding the benchmark rate at 4.25%, with the vote split, however, as a mild surprise. Most analysts had forecast 7-2 outcome. The minutes revealed that Dave Ramsden had joined. Analysts interpreted the decision as a dovish shift and said it raised the likelihood of a rate cut over the summer. Matt Swannell, Chief Economic Advisor to Ernst & Young Item Club, said the vote was likely a sign that the MPC's concerns about the labour market had increased since June. So that mirrors in some ways what we've seen from the Fed and how they look at things at the moment in terms of a deterioration in activity coming over the summer and the latter half of this year. Just to give you the quick numbers on the CPI inflation, we saw an easing to 3.4% year over year in May. Core inflation slows to 3.8%. Goods prices were on the rise, but services inflation cooled sharply. Right, so that's that done. S&B was the other major central bank that I noted last week. Eric, you covered this event for us. What were your views and what happened on that?
Well, I think the decision came in as expected, a quarter-point cut. Nomura, for example, they said there was a 40% chance of a half-point cut, which didn't happen. Most of the market was pointed at a 25 basis point reduction. And I think the big question is what's next. It was widely expected, partially because Swiss inflation's been going down. There's been disinflation, and now in May, the latest number, the annual rate fell by 0.1%. So that, of course, tripped all the let's cut now wires in everybody's heads. And that's exactly what they did. Listen to the board talk during the presser afterwards. I mean, the chairman, Martin Schlegel, admitted that they discussed a bunch of possibilities, and I presume that he meant also a half-point cut. I think the situation now, the S&B is really in a good situation because they make decisions quarterly, right? So they can sit back and watch until September and see how things develop with, for example, oil prices, right? If Iran's threatening to close the Strait of Hormuz, if that happens, that's going to drive inflation. At least I believe that, and I think everybody else does too. So that might pump up inflation in Switzerland. The other concern that the Swiss central bank has, of course, is the exchange rate. I mean, the dollar has been, getting slammed against the Swiss currency. It's down almost 10%.
Right.
since the beginning of the year. And I think that's one thing the Swiss are worried about, is the exchange rate. And they've said they're ready to be active again in the forex market. They've done it before, especially post pandemic. I mean, we're talking about things they've already done, right?
Mm.
To go negative, because the next cut would be negative. I didn't make that clear in the beginning. They went to zero on Thursday, and then another cut takes them negative.
Okay.
They've done it before. They can do it again, and it's the same with intervention in the FX market.
Right, fair enough. Well done. Thank you for that. I just want to quickly mention Norge Bank, which was a bit of a surprise. We were looking for rates to, I think, stay on hold there, and there was a surprise cut from the Norway's central bank. So again, it adds to that narrative and that theme that central banks are looking a little bit more dovish than they probably were even 2-3 months ago, with the uncertainty from the tariff situation, and even the greater uncertainty from the Middle East actions that we've seen. Talking of which, I really want to just push on now and look towards the geopolitical side of things, really. And on Friday, if we'd done this, we would have said, well, Trump said within 2 weeks he'll make up his mind about whether he will get involved, or the US gets involved and decides to bomb Iran's nuclear facilities. He lasted 2 days on the order over the weekend. So, he gave himself a bit of breathing space there. And they did. They hit 3 sites over the weekend and really just ratcheted up the tension in the region, which I'm pretty sure wasn't the intention. They wanted to try and show a strong hand and to show that they're in charge and can intervene at will. So looking at the situation now, just to give you a bit of reaction, we saw oil prices up. I think they were up over 5% at one point. They've now come back down to earth, if you like, and they're trading, I think, near or around Friday level. So we've seen that initial reaction, and equity markets, as you expect, came in on the soft side, and they retained some of that softness there. But we're not seeing the routes that some may have feared from US military involvement in the Middle East. Over the weekend, Trump did explain his decision and touted the Iran bombing, warned more strikes could come, but wanted to see Iran come to the table. US officials are assessing the strikes on Iran's nuclear facilities at the moment. The IAEA has confirmed entrance to Isfahan site was hit by the US strike, but again, as yet, there are no definitive answers on how bad the damage is. We just know that it's relatively bad. In response, Iran has brought out the threats, and there is even a hint that it's set to close the Strait of Hormuz, and signals wider retaliation. Not the best idea if your biggest customer, China, and Asian customers, again, transport a lot of the oil through that strait itself. So you're kind of cutting off your nose to spite your face. Sam, you got any views from a more general market perspective, but if you have any views on the oil market with what's happened?
Yeah, I mean, look, it's kind of the initial reaction is how you expected, right? When you heard about that when futures opened, you saw the haven flow with kind of risk off equity futures lower, spiking higher, sorry, dollar actually getting a bid. Insane to say. But the way the market's positioned, you're kind of out of shorts, which is why I think we started to see this reaction kind of quickly reverse. Like what crude, the front month future contract, I think spiked up to 78, and within I don't know, it felt like a few minutes, it was back down to around $76-$75 a barrel. I think there's certain dynamics at play here too, again, right? There's definitely the war premium that comes in, which I think is kind of, if we're looking at spot prices here right now, around 70, what is it, 75-ish or something like that?
I don't have a chart up in front of me at the moment, but
yeah, I think that's pretty much at equilibrium here. And if this is kind of the worst it's going to get, I think it's very easy for oil to drop down another $5 to $7. And, I like to look at a lot of gamma positioning in markets too. And there's about the money call strikes at $80 on that front month future contract. So I think it's going to have a really difficult time getting over that if nothing else kind of escalates from here. So if it does, push through that 80, it's going to actually need to be a real disruption, right? Not just the risk of it possibly occurring.
Yeah. So well, I'll give you a note here from Deutsche Bank's Jim Reed. In terms of what all this means for markets going forward, it's really all about whether the Iranian regime weaponizes oil, and in particular, whether they seek to close the Strait of Hormuz, where over 20% of the world's oil flows daily. They refer to a report they put out last Monday highlighting Michael Hussey's, I hope I said that right, work, calculating that such a closure could see a spike in oil to around $120 a barrel, which I think is where that ultimate height, as highest level's been. For what it's worth, Polymarket puts the odds of a closure before July at 32% at the moment, up from around 10% on Friday, but well below the 52% that was seen back in the last week London time. Having been around $68 a barrel before concerns over potential Israel strikes against Iran emerged, around a third probability puts oil at around $85 a barrel. So perhaps the financial markets are pricing in a lower probability of a closure. All very back of the envelope stuff, of course, though. And that's from Deutsche Bank there.
Yeah, hey, did you see? I was reading some headlines this morning, and the Iranian parliament did approve the closure of the strait.
Yeah, I saw that too, yeah.
Yeah, but I believe they left it up. I believe I read it. They left it up to, it's the security body that's going to make the final decision.
That's right, yeah. Military chiefs make the decision on that.
I also saw some research that a lot of LNG goes through there too. And I think for Europe, that can be a problem as they're trying to get away from all the Russian LNG, of course, because they don't want to rely on Moscow. So all of a sudden they're cutting deals with countries in the region. And if any of, for example, Germany has been cutting a lot of deals with countries there. So if any of their LNG goes through the strait and the Iranians decide to shut her down, yeah, and I think the other thing is, of course, when everybody starts opening up their cans of whoop ass down there, where's it going to stop?
Very true. I want to get to what's happening this week then. Obviously, that happened over the weekend. We're seeing the ripple effects of that. The US cash equity markets, which haven't opened yet at the time of recording, will be very interesting to see. But going through what we have for the rest of the week, we've seen some flash PMI readings out so far today for the Eurozone in the UK. Eric, just very briefly, can you touch upon the PMIs, what you've seen so far?
Yeah, I was looking at the German ones earlier ahead of the IFO tomorrow, which also looks like it's going to tick higher because most of the polling of German managers was done. This is, of course, IFO, German Business Confidence. Most of the polling was done before the attack, or at least most of the answers are probably in. I mean, PMIs, both the services, at least for Germany, the services and the manufacturing rose, and I think the services beat the expectations. The problem is they're still both under 50, so in contraction territory. I mean, it's still good news. I think the manufacturing number is a multi-year high. But the headline number is the composite number is above 50, just barely. So I think that's good news. We'll see what the IFO says tomorrow. Now everybody's going to take what just happened into effect too, or they're going to have to analyze it.
Yeah, or maybe fade some of that as well. We do have on the geopolitical front, we have a NATO meeting coming up, NATO summit that starts tomorrow and goes on until Wednesday, Tuesday, Wednesday of this week. Trump is set to fly out. He said he's expected to attend the summit in The Hague. From a geopolitical perspective, again, there's maybe a little bit of risk around rhetoric coming out of that, mainly from the US more than anything else. On the central bank front, we have Fed's Powell testifies. It's a semi-annual event. We used to call it the Humphrey Hawkins testimony. He appears at both the Senate and the House and will testify on the Fed's job, basically. Sam, do you pay much store in these events when they come around?
I mean, not a ton, right? Like, I'll always listen in to see if you can try to put together any clues, but I think a lot of it's going to be the same rhetoric that we've heard over the past couple meetings.
Okay.
I feel like some will try to push them a little bit on timing of interest rate cuts, what really try to get a little more out of what they look at the trade policy at, but I really don't think there's going to be anything very material that's going to really affect markets too much.
And we've only just heard from the FOMC anyway, and from Powell himself. So he'd have to go some way to sort of change the narrative and direction of the Fed in any meaningful way at the event. They happen on Tuesday and Wednesday for anyone wanting to listen in, and they go on for a very long time. They can get very boring, and the answer you hear more from the politicians than you do from the central bankers.
Yeah, I just wanted to say I do think we're in for this. June's been pretty slow, right?
Mm.
I think we're in for just a very uneventful end of the month as well. You have a ton of positive gamma in the market, so you kind of get these pinning effects too, right? So high probability we're going to finish this month around 6,000, or there's that JP Morgan caller trade that everyone talks about sitting down there at 59.05 in cash. So I think you close somewhere in there. Then we get the first week of July. We have 4th of July holidays. So I really think this market is going to be pretty much dead until the second, third week of July. I think we start seeing some more activity.
That's good knowledge there. And again, that perspective from someone who doesn't have to trade this intraday, you look at these things from a slightly higher perspective and broader perspective, which is good to know. Just moving on, then we do have durable goods orders out there as well. Oh, sorry, I didn't mention midweek. We've also got the US Senate vote on spending bill. I don't even know if that's going to happen now, because I think there is still some more tweaks that like to happen, and it may not get put in front of senators on when I think it was Wednesday, scheduled for Wednesday. That may be a stretch to get that through there. And there's a lot of contention. There's been a lot of contention over this. So I think that's one of those moving feasts as well. Anything on that from you, Sam, from a market perspective, or you can't really judge these sort of things?
Yeah, I don't think you can judge these things, and I don't think it's till really we get anything on the big beautiful bill. Is that until end of July, beginning of August.
Okay, cool.
I don't think there's not too much there.
Okay, and then we've touched on it before. You've got US PCE inflation data due up this coming Friday, which we've covered. Having had both CPI and PPI, calculations have been done and they've been worked into estimates. So it's very rarely a surprise that we get on that number there. So post FOMC, I think even Fed's Powell, like you said, Sam has mentioned that already. I just wanted to very quickly touch upon there's one other political note I've got down here. German budget. Eric, we're rounding off the show now, wrapping it up. Anything from that German budget this week? That's due midweek as well, I think.
Yeah, Tuesday, the finance minister, Lars Klingbeil, who's also head of the SPD, which is the Social Democrats, they're the junior party in the coalition. He's going to introduce his budget to the cabinet tomorrow, at least it's scheduled. And that's when we'll really start to see some detail. I'm sure it's going to get out to the media about how much the government plans to spend. Listen, they have these special funds for infrastructure and climate investment, and he said they plan on investing 2% of GDP this year in defense, and then up to 3.5% this year, he said recently in an interview. I mean, that's big money for Germany. And so this is really where we're going to see whether the transition works, right, into at least a Cold War economy from what it has been to this date, and how the other parties react to it, how the populace react to it. There's already talks of spending cuts for social services and foreign aid. How that goes over, we'll probably know a lot more in the next month or so. The first reading in the lower house is early July, and they expect this won't be decided upon before the summer break. So the decision's probably going to come in mid-September, and then right after that, they're into the 2026 budgets. So that's going to be busy in Berlin.
Interesting. Okay, guys. Well, thank you very much. That's all we got time for in this very, very busy episode. But I'd like to thank my two guests, Sam Cutler of 333 Capital. Thank you.
Always a pleasure, Harry. Hopefully next month some things happen and we start having some more interesting, more detailed stuff to chat about.
Yeah, it's been very dull, very, very dull and uneventful. And Eric, thank you.
Always good to talk to you.
Brilliant. Just quickly to wind this up then. So we, as well as hearing from Fed Powell, we'll hear from Lagarde a number of days this week as well. And some senior officials from the ECB. Bank of England's Governor Bailey, Green, Ramsden and Breeden all speak on Tuesday. We'll also hear from, as I said, Fed Powell on 2 days. We've got Bank of Japan summary of opinions of the June meeting. That comes on Wednesday alongside Tamura speaking. More Bank of England speakers from Lombard Delhi this time round. And then on the back end of the week, again, a whole host of Fed speakers, ECB speakers as well, heading into the back end of the week. So just be aware, this is going to be, listen, last week was busy. This week, I think we'll be just as busy in terms of activity around central banks and geopolitics. Whether that translates into the market and getting the real banks and paper coming in and shifting things around is another matter. So it can be very noisy, put it that way, and volatile without actually too much happening. But we'll keep an eye on the geopolitical ramifications of what we've seen anyway. So thank you very much for listening. This goes out today, the 23rd of June, US morning. So we'll push it out then. But listen in every week for our review. And again, take a trial of LiveSquawk.com if you don't know who we are and what we do, and see if it's something that will help your trading day. Thank you.